Walmart has done the unthinkable by putting a police station in a Walmart store because of the enormous amount of retail theft amid this economic collapse. Hey, everybody, you're watching Bull, Boom, Bear Bust. My name is JJ. Let's get right into it here. A Walmart in Atlanta, Georgia, and this is out of Fortune. Retail theft has gotten so bad, Walmart is building a police station inside an Atlanta store. When the Walmart drive reopens next May, after arsonists set fire to the big box store, it will come with a new feature to hit back at the growing wave of retail theft here. That's out of Fortune. A lot of different news outlets reporting on this. Folks, this is what retailers are going to have to do. They're going to have to hire their own police. Now, from what I read from this article, they're going to use city funds for this. But I talked, maybe a week ago, 2 weeks ago, about my conversation with a Walmart worker here in my neck of the woods here in Southern California, who said 1.4 million walked out of the store unpaid for just at his location in the last year, and they were told not to interfere with the people taking things. So this has got to be the logical next step. I mean, are these stores just going to go out of business? You can't just lose millions of dollars a year. For one, it's going to impact the people that do pay, honest people. You're going to be paying for everyone else taking stuff. That's the bottom line. It's kind of like insurance, right? If you have no claims, you're still paying for the people that did have claims. So there's no easy way out of this. But Walmart using their own police force. Now, this was a severely burdened location, to say the least. Somebody set fires. They're saying that the fires were set by people stealing things to distract from the fact that they were walking out of the store with just carts and carts full of items. Pretty crazy. And some of the videos I've got here from some interactions between security and the people taking things, I can't even play them because some of them are so crazy. Now, what kind of bothers me about this whole thing is a lot of people are just saying, "Oh, this is normal. There's always been people stealing things." Yes, there's always been people stealing things, but not to this degree. And I think a large part of it is because of the economic collapse. The cost of living is too high. People are not making enough in wages to keep up with the cost of living. 100 million people nearly out of the labor force, but yet they're telling us the unemployment rate's below 4%. It's a huge joke. It's just outrageous how this economic collapse is being, I think, covered up, in my opinion. But let's get into some other news today. A lot of things we're going to cover today are going to actually kind of open up your eyes here. If you don't already believe that the economy is in severe trouble, I think you're going to believe it after we get some of the news out here today that we're going to talk about. Recent news here out of Yahoo Finance. Wage gains are slowing for job hoppers. Another sign the labor market is losing steam. So remember back in 2020 with the work at home craze, a lot of people were leaving for better paying jobs and they were getting better wages. With the false economic boom that came with all the stimulus, all the canceled payments, people had a lot of extra money to spend, and they spent it. A lot of times they spent it online, renovating their homes, getting their homes set up for work at home situations. And that did create an economic boom, and it pushed prices up, unfortunately, and prices really still haven't come down. In fact, they're still going up. They're just not going up as fast, but that's supposed to be good news. Anyways, we'll talk about that in a different video. Here is some statistics here. Job gains in each of the last 3 months have been below 200,000. The unemployment rate is now ticked up to an 18-month high. We talked about that just a couple of reports ago as well. And job openings fell to a 2-year low in July. So, folks, the slowdown is finally becoming so obvious that even mainstream news outlets are reporting on. And now some of the biggest beneficiaries of the pandemic era labor job market are seeing their leverage in the labor market erode job hoppers. So now it had to happen. I mean, we talked about this. All the people losing their job in the mortgage industry, the real estate industry, the appraisers, the loan officers, the underwriters, the funders, the title representatives, everything tied to it, right? The real estate agents. When they go to find a job, a different job after getting laid off, a lot of times they're not finding a job that pays as good. We're now seeing former real estate workers now as Uber drivers. former real estate workers now working in fast food. Nothing against those occupations, but typically they don't pay as much as they do when when real estate's booming. You make pretty good typically, unless you're just a really bad loan officer or bad real estate agent. The 3-month average of annual wage growth for job switchers dropped to 5.6% in August, down 8.5% from July 2022. So in just over a year, that's a pretty big drop, and barely higher than the 5.2% wage growth seen by those who didn't change jobs last month. So they're saying that the people that didn't change jobs had 5.2% wage growth. I'd have to think that the CEOs might have pushed that up, because the average worker, I don't think, is making a 5% salary increase every year. We did see a big increase for UPS drivers, and maybe that helped average it out. Well, actually, no, this is before the whole UPS thing. So I don't believe that number at all. Do you believe people are getting an average of 5% pay raise each year? And these are people that didn't change the job. So this would be a pay raise of over 5%. I really don't think so. Overall wage gains in August stood at 5.3%, down from a peak 6.7% in the same month last year. So the slowdown is real. It's happening. You're not going to see it all at once. Like a lot of people have been predicting a crash. Sure, there could be a crash. Something big could break, and we could wake up and the markets will be down 50% overnight. But unless something crazy like that happens, this is playing out in slow motion. And that's why they had to raise rates very slowly and incrementally, because the amounts of debt would have caused an economic implosion with bigger and steeper rate hikes. Still on the topic of wage growth and pay rate hikes, GM's offer of a 16% pay hike ahead of the strike deadline is quickly rejected by the UAW, United Auto Workers Union. Ford also offered a pretty nice pay increase, but it was not as much as this labor union had wanted. General Motors made a counter offer to the United Auto Workers Union, proposing a total 16% pay raise for the top wage earners in its plants and a 56% hike for newer employees who make less, the company said in a statement. Wow, those are some pretty big rate hikes. But guess what? The cost of living has these workers looking for more. You see, this is the problem with the cost of living. You always have to demand higher and higher wages. So it's a never-ending game of catch up, right? Not the condiment. Catch up. You're catching up the cost of living. You're trying to keep up with it. You're trying to catch up to it. But it's impossible. And so we have these never-ending talks of strikes over here, strikes over there. Look at what's happening with the movies right now, the actors, everything up in Hollywood. A lot of those actors are feeling a lot of pain, some of them having to sell their house, some of them having to move out of LA, move back home, maybe with mom and dad, maybe back to Kansas somewhere. It's pretty interesting what's happening in the economy right now, and a lot of it really hasn't been felt yet, except for people are feeling it in their wallets and their pocketbooks, because the debt levels, we've never seen this type of debt before, and it's not going to go anywhere unless they do some massive debt forgiveness. But see, that's also dangerous. That's like cutting rates. It would have the same effect. You would see prices skyrocket. If they did some sort of massive debt forgiveness, student loans, auto loans, mortgages, let's say they just wiped out all the debt, you would see prices skyrocket. Why? Because then people would have so much more borrowing power. Because when they look at your debt to income ratio, all those things, you're going to qualify for a bigger loan. So you'd see home prices go back up by, I think, 20% in 1 year, probably even more. Car prices would be up by 20, 30% in 1 year if they did this debt forgiveness. Same thing if they cut rates. It wouldn't be as drastic if they cut rates. I think prices would still jump up pretty quickly. Let's say they dropped rates back down to rock bottom, like the 0.25%, like we had for nearly 10 years. Prices would explode upward once again, because the borrowing capabilities would then be greatly increased. And we know what happens when people can borrow money. Prices get pushed up, the cost of living goes up, asset prices jump up, and a lot of that money makes its way into the stock market. Now, speaking of the stock market, it was a pretty bad week for most, just about every index down on the week. And, this could be a topping sign as these items come to light and in the real financial picture. Now, a lot of investors, they just look at CNBC and find out what they're talking about. CNBC says the unemployment rate's near a 50-year low. Everything must be fine. But in the background, we see stories like what we talk about here just about every episode, letting you know the real economic situation and what we like to call here economic reality. Let's shift gears a little bit here. The dollar set for the longest rally in years, with U.S. defying global gloom. We talked about that right here. Unless they come out with some global gold-backed currency, not even global, just several nations with backing their currency by gold, would really put a lot of pressure on the dollar. But this talk of just other countries, coming to an alliance and trading outside of the dollar, so far it's not having a very big effect. But remember, a lot of people are running to the dollar because of the higher yields. You can now park your dollars in a CD and a money market, and some places get more than 5% annual yields back on your money. So the Fed is doing their job as far as protecting the dollar, and this is one of the reasons why you see the dollar staying pretty strong compared to other currencies because of the rate hikes. Is it enough to stop inflation? No, but it is keeping the dollar from collapsing. Let's talk about this here. China, imports of Iran oil have soared, and basically they're defying U.S. sanctions because countries, the United States, do not want countries trading with certain other countries that we're sanctioning. And I think you know the names of those countries. So basically, China is giving the big, what finger to the United States and importing all of this oil. Of course, the United States, we're no longer a net producer of oil like we were in the recent past. We're now a net importer of oil, and oil prices are going up, and you're going to see prices at the pump go up a lot more too. And it's already $5 a gallon here in California. It's going to get a lot worse, folks. So buckle up for that. Brace. Save your pennies for that because it's coming. Recent report here: bank deposits plunged again. Sorry, I've got my bug zapper over here. I've got an indoor bug zapper because the mosquitoes are so bad here. I filmed this in my garage, by the way, so that's the reason why I have a bug zapper out here. A lot of bugs in here. Bank deposits fell on a seasonally adjusted basis by 70 billion last week. That's the lowest. So this is the lowest that the total bank deposits has been since last May. So we're not seeing a recovery in smaller or regional banks from the big outflows that we saw starting back in March. And that's largely because people are draining their accounts just to keep up with the cost of living. People are also pulling a shocking amount of funds out of their retirement accounts just to skate by. So it's going to be very interesting to keep an eye on this here. We're going to definitely, watch these deposits and see the direction. I think it's going to continue to trend downward. All right, transitioning once again here. Let's talk about car prices. Used vehicle prices may have bottomed for 2023 after prices increased in August. We talked about this, right? So even with higher interest rates, car prices are still remaining very elevated, and they went up from July to August. And we haven't even really seen major turmoil with car production yet. Now, imagine what's going to happen if these auto workers continue to strike, if they don't come up with an agreement. Imagine what's going to happen if there's a conflict over in Taiwan that produces the most chips for these automobiles that are essential for automobile production. What if something big disrupts production like it did in 2020? Maybe not the exact same thing, maybe something else, but a disruption in production could make prices go up again even more on vehicles, right? So pretty scary when you think about it. I mean, prices went up so much, and we're not seeing price corrections hardly anywhere like a lot of people expected. Not in fuel, not in homes, rents, not in cars, the grocery bills, electric bills, insurance bills, all going up or just staying high and not really coming down much at all. So pretty scary, folks, pretty scary. And this all goes back to the system of money. So let's talk about something else here that's been in the news quite frequently over the past few years is the amount of gold buying by central banks. Central banks' gold buying continued hot in July. This is what central banks are doing. They're not just printing paper and leaving pallets of paper sitting in their warehouse because, paper dollars are where it's at. No, paper dollars are not where it's at. And in fact, most currency right now is not even paper currency or coins. It's digital. right? Over 90% of its digital money. So just digits on the screen. They can type up as many dollars as they want to. They can click a mouse, can create billions and billions and billions of dollars, as you probably all know by now. So gold is where it's at. Ultimately, we're going to go back to this, and I think that's why central banks are hoarding gold. Globally, central banks reported net purchases of 55 tons of gold in July, according to the latest data compiled by the World Gold Council. So again, ask yourself, why are they not printing 55 tons of paper bills and just setting them in pallets in the warehouses, right? Because it's paper. Something is going to make this economy, is going to make this monetary system go back to gold. I think it's going to be a global depression, unfortunately. I know that sounds crazy, but there's a reason why central banks are hoarding and buying gold. Think about this. They're buying gold with currency they can just create on a digital screen somewhere, but they're buying real tangible assets, and especially gold. Pretty crazy. It was confirmed in June when the Central Bank of Turkey flipped back to adding 11 tons of gold to its reserves. It continued increasing its reserves in July with a 17-ton gold purchase. The People's Bank of China ranked the largest buyer in July, adding 23 tons of gold to its holdings, the 9th consecutive month of buying for the Chinese central bank. So another sign that paper bills may not be where it's at. You do get a nice return, though. Going back to what we said earlier, a 5% return for your money market or CD. It's keeping the dollar rather strong, actually, even amid all this uncertainty. The Wall Street Journal, Kroger says supermarket sales are under pressure as shoppers pull back. We've been warning you that consumers are getting close to their credit card limits. Consumers scrutinize spending as inflation eases. Yeah, not really. Kroger agrees to sell stores to C&S as it pursues the Albertsons deal. But here's the thing about it. Even if shoppers do pull back, meaning they're not buying as much, they're probably just spending more. Sorry, there goes the bug zapper again. They're probably just spending more because costs are so elevated. So then that's chalked up as GDP, and it makes the GDP number look better. The more expensive things are, the better the GDP is. Then they can use that GDP number to say, hey, look how much people spent. Look at the GDP growth. We're not in a recession, right? So they use high prices and inflation against you, and they use people racking up debt against you, or they use it as a way to justify how great the economy is, when in reality, the economic growth is a lot of people taking on a lot of debt. So that's the truth about it, folks. Where does this end up? You let me know. Ultimately, we're going back to sound money. How many years is it going to be? Is it going to be a few months? Is it going to be maybe a few years before this whole thing implodes and we're forced to go back to real hard assets and sound money? I'd like to know what you think down in comments, everybody. Thanks, everybody, for being here. Thanks for listening. Thanks for watching. And keep stacking, everybody. As always, big love. Bye for now. Peace.